Hi guys, I'm AP. In this video, we are going to see the chapter 6 in the book The Intelligent Investor. The chapter 6 is the portfolio policy of the enterprising investor negative approach. It is nothing but the negative sides in the portfolio of the enterprising investor. So let's get started. Okay, at first itself, Graham gives the credit to the British economist John Maynard Keynes for the term enterprising investor. The enterprising is a synonym which is invented by the investor and the great economist John Keynes. He is the father of macroeconomics, and the diagram is so clear that there are only two types of investor: one defensive investor, and second one is the aggressive investor. The defensive investor is who do not spend much time and energy in the market by analyzing. He will select a high grade bonds and a common stocks, and he will let it in an autopilot mode by continuously investing a small amount over the period of time. And the aggressive investor is who spends a lot of time and energy in the market to analyze the securities, and he is constantly and continuously changing his portfolio to get a high returns in the markets. So this is the definition given by the Graham. He is so clear about the defensive and the aggressive investor. The aggressive investor is who spends more time in the market to get the high returns. Okay. Now let us see the negative approach by the aggressive investor while selecting a bond. Okay. To get a higher returns, the aggressive investor tend to invest in the bonds with high yields to get a high returns. Okay. But he will not look at the ratings and the credibility of the company. The ratings are, if the bond has a AAA rating, then it is a highest safety bond. If the bond has a AA rating, then it is a higher safety bond. And if the bond has a just A rating, then it's a safety bond. And if the bond has a B rating and follow on, it has a moderate risk bonds. Okay. If the bond has a highest ratings, then the bond will tend to give a low returns. It means the bond, the credibility is so high. For example, the government of India releasing the bond which is a high rate bonds, but the default risk is so low and the interest is also so low. But the aggressive investor tend to invest in the high yield bonds for higher returns, but the ratings of the bond will be so low. Okay, the credit rating of the bond are given by the companies like CRISIL, ICRA, or CARE. These are the companies which have the analyst and they employ them to analyze the bonds, their credibility, their default risk, and their financial situations of the companies, and they will give rating accordingly. Okay, now let us see some simple terms in bonds. Okay, the bond will issue in a face value and with the multiplies of it. Now let us consider if the bond has a face value of 100 and the coupon rate is 7%. The coupon rate is nothing but the interest how much they are going to pay. Okay, now if the face value is 100 and the coupon rate is 7, then for 1 year the issuer will pay 7 rupees for you. Then you get a 7% return from it. Now let us consider if we buying the bond at some premium to the face value. If we buy the bond at rupees 101, the issuer will pay the 7 rupees as the interest, but the yield will be slightly low for us because we are buying the bond at a premium level. Okay, now let us consider if we are buying the bond at a discount level at 99, even though the issuer will pay us 7 rupees for that according to the face value 100. Now our yield will be slightly high more than the 7%. This is the jargons in bond trading. The aggressive investor tend to buy a high yield bonds in the discount rate, and he will get the high returns in the face value, and he will make some extra yield by getting the bond in a discount value, but he will never look at the risk appetite in the bond. This is what Graham says is the negative side. While buying a bond at a discount rate, the aggressive investor will never see the downside in it. Okay. By buying a bond to discount to its face value, then we have a slight advantage that the bond, every bond will expires at the face value. If we buy a bond even though at the discount rate to the face value, the company when they are collecting the bond and giving you the premium amount, they will give you the premium of the face value to it. If we buy the bond at 99 rupees at secondary market, and if we sell that bond to the company, and the company will give you the 100 rupees as a premium to you. In some exceptional cases, if we buy a very good company's bond at discount value, then we may tend to get a higher returns from it. Okay. Now let me show you how a bond broker's terminal looks. Okay. For study purpose, let us look at this website indiabonds.com. Indiabonds.com is a bond broker that offers you very variety of information about bond. Okay. In this, let us click explore, and here are the tabs coming in here. Okay, now we can select the bonds whatever we want. Okay, in left side we see the returns. What do we need? If we need the return up to 4 to 7 percentage, or 7 to 10 percentage, or above 10 percentages, and how much the tenure of the bond, how much the expiry date should be, within 1 year, or 1 year to 3 years, or 3 year to 5 years, or more than 5 years. Okay, and the interest payment frequency, we need a monthly interest payment, or a quarterly interest, or a semi-annual interest, or annually interest, and a cumulative at maturity. Okay, now we can also filter the ratings of the bond, triple A, double A bond, and A bonds. Okay, now let us see a public issue of a bond. Okay, in this product I'm clicking public issue. Okay, public issue is nothing but the new offerings. Now only the bond is arriving for the fresh issue market. Okay, now we see the Muthoot FinCorp Limited is issuing a bond for 400 crores. Okay, at the highest yield of 9.43, and I'm clicking here for read more. Okay, now let us see the bond opening date is September 1, 2023, and the closing date is 14th September. And it's a 14 days the bond issue will be open, and we can subscribe to this. And the allotment is first come first serve. Whoever is applying first, they will serve. And the bond size is 400 crores, and the highest yield is about 9.43 percentage, and minimum investment is 10,000 rupees, and the bond rating is crystal AA minus, and it's a stable one. Okay, if we now come down here, we see the issue price is the face value of the bond. Okay, that 1000 is the face value of the bond. It's a non-convertible debentures. Okay, the issue size is 400 crore, and minimum investment is 10,000 rupees. It's a 10 in series. If we multiply the face value into the per unit, then we get the minimum investment amount. Okay, and then this bond is going to list on BSE, so that in secondary market, whenever we want to sell the market, we can sell it. Okay, then we see the ratings, and the open date of this is September 1, 2023. The issue will close on 14th September, and it's a public issue. Every retail investor can invest in here. Okay, by coming here, we can see the series of bonds they are listing. Okay, now the bond are divided into monthly payments. Like if the bond is paying you monthly frequency, then that will be categorized, and the annual payments will be categorized, and the cumulative interest payment will be categorized. Okay, and then in series 1 bond, the expiry of the bond is around 2 years, it's 24 months, and the interest will pay you at monthly, and for that the yield is 8.65, and the effective yield per annum is 8.99. This is for series 1 bonds, and for series 2 bonds, the maturity period is 36 months, and the monthly they will give an interest payout for you, and the coupon rate is 8.90, and the effective yield per annum is 9.26. Okay, in third also the monthly frequency payment, and the tenure is 60 months, and then the following so on. But if we are buying a monthly frequency of payment bonds, then the coupon rate will be slightly lower than the annual interest payout series. If we see compare the 24 months expiry bonds with monthly and for annum, then we can see 8.65 coupon rate, and for same bond expiring in 2 years, we can get a 9 percentage of interest in it. This is because that if we get an interest monthly, then our risk of default will be so low. But for if you are getting for annum, then our risk will be slightly high, so that the yield also high. Here we can see the allocation ratios. It is like category 1 institutional investors 5%, that is about 20 crores. Category 2 non-institutional investors, maybe high net worth individuals, for them they are allotting 35%, and for retail investors they are giving up to 60%, that is 240 crores. Okay, now let us see the bond tradings. If I click bond tradings, then okay, these are the bonds that are available in the secondary markets. Someone want to sell then we can buy it. Okay, now I'm categorized this bond into just clicking AAA ratings. I just want a AAA rating bonds. If I click that, then just to explore, let us click India Grid Trust bond. Okay, now here we can see it is a secured regular bond debenture. Okay, and the rating is AAA, and the coupon rate is 8.2, and the interest payment is for annually, and the maturity of this is at 2031. It's about 7 years from now, and the yield to maturity is 8.1. The coupon rate and yield is slightly below because the market value is uh, premium to the face value of the bond, so that the yield is slightly low for us. Okay, now the allotment is at 2021 May 6, the bond is issued. Until now, the bond has paid 2 years interest for the investors. And at May 6, 2024, the last payment has done. Sorry, the next payment is on May 6, 2024. And if you are seeing here the face value of the bond, the market value, and the principal amount is into 100 units. 1000 into 100, it's 1 lakh. And the market value is 1004 rupees into 100, that is 1 lakh for 450 rupees. For if we buy, we want to have a minimum investment of 1 lakh 40, 1 lakh 450 rupees. Okay, the accrued interest is nothing but okay, let me show you here. The last interest payment is done on May 6, 2023. Okay, we can see from May 6, 2023, it's been 123 days till today. Okay, if we see here, uh, for 1 year, the bond is paying you 8,200 rupees for 1 lakh. 8,200 rupees for 1 lakh. This is for 1 year. Now we are going to divide it by 365 days, and for 1 day the bond is giving you 22.46 rupees. Okay, from May 6, that is the last interest payment, that till now it's been 123 days. Okay, now we are going to multiply 123 into this per day interest of the bond. Okay, we are here is 2,763 rupees. Now we see, now if we see here, the accrued interest is 2,788. It is for up to September 7 only. We have for 1 day we have extra in it. Okay, that is the accrued interest. And if we are placing the principal amount and the accrued amount, then our total investment will come around 1,03,231 rupees. We are buying the bond at premium, so that our yield could be so low in this. Okay, in the right side we can see the issue size. It is about 599 crores, and the listing details we can see here. If our investment is 1,03,231 rupees, then that's principal amount plus our accrued interest. At final, we can get about 1,65,600 rupees, the total amount. Okay, at 2028, the interest we can collect is around 65,600 rupees, and they will pay back the principal amount. We are buying at some premium, but we get the face value at our final payment. Other principal amount is this, and we can see the interest payment schedule date also here. If you want to buy it, just click buy, and we can buy. Okay, before buying the bond, we can see what are the risks here. Okay, and then we are having the GSEC bonds here, the government issued bonds. A description, I give some other website also for your education purpose. Okay, now let us see the negative side of the aggressive investor when he is selecting a stocks. Okay, Ram is totally opposite to the IPOs, that is initial public offerings, because one who never know what the company's profit is, and in long run what the company is expected to accomplish. Without knowing this, one should never invest in the IPOs. Ram says lot of negative points about investing in IPOs, but for now, we always consider buying a high grade bonds and a common stock portfolio. The common stock should be large, prominent, and conservative in finance. Don't apply in IPOs. Graham says some 3 to 4 points that are The company is releasing IPO because they want to give an exit to their already existing investors, or they want to get some more profit by listing the IPO price at so high, so that the investors should never get in the IPO trap. We always can wait until the price settle down by reading the financial statements and analyzing the promoters, and we can buy that company later if it is coming under our common stock category. Okay, let me conclude this video by saying that aggressive investing is not for every retail investors. We just follow the Graham's advice of defensive investor by just buying the high grade bonds and the common stock portfolio. That's it for now. In the next video, we can see the enterprising investors and this positive sides. Okay, stay tuned. Thank you.